We are in the middle of an everything bubble, everything rally. You choose the definition, you choose the term, but everything is going up as we speak. Gold, over $4,000. Silver, over $51. The S&P 500, as we record, up 1.2% in the futures market. The dollar is doing better. The Dixie's at over 99 points, and the bond yields are dropping as well. What is going on in the world? What is happening? I've invited the Godfather of Liquidity onto the program. His name is Michael Howell. He's the brain behind CrossBorder Capital, and I'm excited to welcome him back in a few short seconds. But before I switch over to my guest, hit that like and subscribe button. It helps us out tremendously, and we much appreciate it. Now, Michael, the Godfather of Liquidity, it's great to welcome you back. It's good to see you again.
Well, hi, Kai. It's great to be here, and exciting times. Lots going on, and lots of peaks occurring.
Absolutely. The question is, like, where are we in this cycle? Why are we in what? I actually don't even know how to ask the question, Michael. What is happening? Maybe we'll start at the top and then we'll work our way down. Let's start there.
Okay. Well, I think the first thing to say is that liquidity has been rising strongly, as we know, pretty much since the low point in October of 2022. It's in a strong uptrend, but it's also seeing a sharp cyclical rise. And I think one's got to understand liquidity by differentiating the cycle from the trend. The trend is going very strongly, and that trend is with us well over the medium term. I mean, we're in an era that I describe as monetary inflation, where basically the only way to get out of the huge debt that we've got in the world economy is to monetize it. And that basically means creating lots of liquidity. The trend is definitively going up. But on top of that, we're seeing a cycle. And that cycle is a cycle which is driven by central bank policy, among other things. It's related to the real economy. It's related to the speed of debt refinancing, etc. And that may well be coming closer to a peak. So I think you've got to take these two things separately. The trend is unambiguously strong and rising. But on top of the trend, there is a cycle. And at the moment, the trend is going up, the cycle is going up, but be ready for some cyclical turn, some inflection, over the next 6 to 12 months. And that's really what we're trying to anticipate.
Yeah, we'll get to that part in a second, because we'll look at some charts, and you brought us a presentation that we'll go through here in a second as well. But are you concerned, or I don't want to use the word confused, because you obviously know what you're talking about, but maybe I'm a bit confused because everything's going up right now. All the asset classes, I mentioned it in the intro, doesn't matter if it's stocks, bonds, the dollar, the currencies, gold, silver. Why is that? Why is liquidity flooding all the markets, all the asset classes?
Because pure and simple, it's a monetary inflation. There's a lot of liquidity being created, and the vent is financial assets, or the first event is financial assets, and that's why everything is rising. We're in an everything bubble. And we've been in that period for some time, but it's now accelerating. People are starting to realize that they're losing out. There is a fear of missing out going on for sure. But basically, everybody needs to protect their wealth. It's not that we've got high street inflation, certainly not yet, but we've got monetary inflation. And the first dimension of monetary inflation is really reflected in asset price inflation. And that's pretty much what we've got. So if you're printing money, this is where it's going. It's going into financial markets and other assets. Plain as that. It's straightforward.
Maybe if you phrase it as financial markets, it makes sense. But it used to be, not too long ago, like 6 months ago, maybe only the S&P 500 went up. Everything else sort of moved sideways. Gold only started moving in March, really. Or the mining market started moving in March. Like, why is it everything now? The money used to be very selective. Now it's everything. Like, what has changed there? Why is it not as selective anymore?
Yeah, because I think that what people are beginning to realize is that this is not just a cyclical change. It's a trend change. And, if you look at, for example, the slides I sent you, if you look at the first slide, what you can see there is a chart which basically looks at gold bullion in US dollar terms against real interest rates. Now, traditionally, everyone has understood the fact that the gold price, the orange line there, has been related inversely to real interest rates. So the black line is US TIPS, Treasury inflation protected security yields, inverted. And up until that period that we've circled in early 2022, there was a very neat relationship where whenever real interest rates went up, in other words, the black line on the chart goes down, the gold price fell. And whenever interest rates came down, real interest rates came down, so the black line going up, then you'd expect the gold price to move upwards. What you saw very clearly in that period that we identify as the break is that real interest rates started to go up, but the gold price really soared. And the point is that that break, which some people ascribe to the Ukrainian invasion, I think it's a lot more than that. That's the mark, I think, was when you started to see central banks and government become a lot more profligate and running very imprudent monetary policies. There was a lot more monetization. This was a period in particular where I describe Yellonomics came on, where you basically saw the Treasury issuing lots and lots of Treasury bills. In other words, funding the deficit through the short end of the market. That is reckless in monetary terms. And I think investors worldwide started to realize what was going on. Now, the associated Ukraine invasion didn't help them, the situation, where Russian assets being sequestrated basically persuaded a lot of governments to say, look, what we've got to do here is to start shifting more and more towards assets which are gold-backed. And that's exactly what we've been seeing. So effectively, there's a restriction in supply to the free world, if you like, or to free markets, the private sector, which is the orange line, shooting up on that basis. And then on top of that, you've got a monetary explosion as liquidity has been created, which has pushed the orange line up even faster. So it's a combination of increased demand as that liquidity gets pushed in, combined with a restriction in supply as central banks start to hoover up more free supply.
Is it fair to lump gold and silver in particular into the same asset classes as the S&P 500, as the bond market, even the dollar right now? Is it fair to lump it together, or are those separate asset classes and we should look at them from a different point of view, perhaps, because different factors at play, perhaps?
Well, I think you've got to put the bond market to one side, because I think that is different dynamics. But I think if you look at the other factors, if you look at gold, you look at silver, you look at crypto, from a demand point of view, it is exactly the same story, and that's responding to monetary inflation. So all these traditional monetary inflation hedges are basically going up, and you might extend that, although I think the equation has changed a tad here, for prime residential real estate. That's another monetary inflation hedge. But generally, the prime hedges, which you would say are gold and probably large cap equities, they're really benefiting significantly, and silver is catching up. Silver's clearly got industrial uses too, but just note the fact that silver, platinum, palladium, gold, they're all moving significantly in an upwards direction.
When I look at this chart, it feels like there was a massive lag, though, between gold moving and all the factors that we've discussed. Why is it now so parabolic? Why does it feel like it's such a violent move, while instead it could have just gone up slowly and steadily ever since 2022, as you mentioned? It feels like just the last few months, ever since pretty much March, gold is on a tear. Before, it was almost negligible, that move.
Well, I would say that what you're seeing is that you're seeing a cyclical move in liquidity. I mean, that's what I've been arguing for the last 3 years. But it's now it's accelerating because we're coming towards the top of the cycle, and there's a great sort of FOMO, a fear of missing out by investors who realize that gold has gone up and they need some sort of monetary inflation hedge. They realize what's going on more and more across governments, and they're seeing the stark fact that we're not just necessarily in a high street inflation. I think you need to make this distinction. It's not necessarily high street inflation, but it is monetary inflation. So it's the devaluation of paper money, and that is being purposeful, and it's deliberate, and it's occurring really across the West. And you start to look at the broken finances in a lot of countries, you start to realize that this is actually a real threat to investors worldwide. So they're scrambling on this bandwagon. So I think that that's going on. Now, I think if you add to that and you say, well, okay, is this purely geopolitics? Is it the fact that Russian assets were sequestrated and central banks outside of the West scrambling for gold? I think it's more than that. Because if you talk to scrap metal dealers, what they tell you is that normally in a big move like this for gold and precious metals, they would start to see new supply being given to them. In other words, people are trading in their gold and swapping it because prices are high. But that's just not happening. So what you're getting is a real supply shortage coming on. given the demand that's out there. And I think these are significant changes. Now, that's not to say that markets go up in straight lines, because they don't. But I think one's got to start thinking about the difference between the cycle and the trend. And if you look at maybe a slide further on from the one that you just had, we can see how this starts to evolve. Now, maybe we skip this next one because this is a US deficit. But look at this one. This is a really interesting one. Now, this data, I'm going to have to explain what's going on here. But what you've got is the orange line, which is basically showing what I call the structural deficit in the US. That structural deficit consists of effectively four things. It consists of Medicare spending. It consists of Social Security. It consists of interest payments on the debt. And it consists of defense spending. Now, these numbers come from the Congressional Budget Office. So it's it's a bipartisan but semi-official source in the US. Goes right up to 2050. The only difference that I've made in their calculations is I've assumed that defense spending in the US hits the NATO target of 5% of GDP. So that's the only difference. Otherwise, it's the same figures. The other thing that you've got to take into account in the CBO projections is they never project a recession. So these figures are likely to be conservative because the budget deficit blows out in recessions. We know that. This is showing you how much that budget deficit, that structural budget deficit, goes up. Okay, so this is excluding discretionary spending items. It's the underlying, it's the core of the budget. That is an unbelievable increase. And what you can see alongside is the broken line, the black broken line, which is effectively looking at debt to GDP, the consequences for debt to GDP. That skyrockets up to 250% of GDP by 2050. Now, these are eye-watering numbers, okay? This means that you've got a real problem in terms of financing the deficit. Now, does it mean that the deficit won't be funded? No way, because governments always find a way to fund. They either do it through debt issuance at the longer end, forcing interest rates up, or what they do is they print money. Now, spoiler alert is what's going on right now is they're issuing at the front end. They're doing a lot of bill issuance and short-dated debt issuance, which the banks hoover up because they love that stuff, and that is pure monetization of the deficit. Now, what does that mean? It means that basically monetary inflation hedges go up medium term. If you go to the next chart, what we've done here is to basically say, well, okay, let's look at that rise in debt to GDP that is being caused by this structural deficit. And let's say, okay, let's hold the debt constant in gold terms, okay? That stock of debt. What would the gold price need to be? Because you can't create gold. You've got a constant stock by definition. What happens if you start to see that the gold price going up to match that increase in debt? And that exponential curve there, which you can read off, pretty much tells you what's going to happen. And what that is saying is, you start to look through these numbers, you're looking at sky high levels for the gold price going forward. I mean, easily $10,000, $15,000 per ounce in the 2030s. And then you get right up to 25,000 or so by 2050. I mean, these are eye-watering numbers, but they seem unrealistic. But hey, listen to this story. In year 2000, what was US federal government debt? It was about, it was a figure which is about a tenth of where we are today. So you've got 28 trillion of debt today. That's gone up 10 times since year 2000, okay, in 25 years. How much has the S&P gone up in that time? Answer, less than 5 times. How much has the gold price gone up? 13 times. Now, what that's telling us is that gold matches or more than matches the increase in federal government debt. But it is not just about the federal government. This is about Western governments. It's about all governments, in fact. Everybody needs to devalue their debt, and there are big debt burdens out there. Now, what I'd like to do is to shift on to the other side of this story, which no one really talks about, and that is what's happening to China. So I'm going to ask you to flip on in the presentation, Kai, and go to some slides right towards the end. We can get back to the middle bit, but that's looking at the cycle. And I'm going to go right towards the end, which is looking at China, and maybe a couple more, a few more, but we're getting towards that point. Next one, that's it, this one. Now, this is looking at the debt to GDP ratio of Japan, shown there in black, and China, shown there in orange. Now, the point that we make is that it's not debt to GDP that really matters so much when it comes to refinancing debt. It's debt to liquidity. Because in other words, debt has to be rolled over and you need liquidity to do the roll. Debt to GDP doesn't really tell us very much in that regard. Debt to liquidity does. You need liquidity to roll the debt over. Now, Japan's problem was that it had this huge bubble in debt and it had refinancing problems because at the same time as debt was going up, it was tightening liquidity, viz. The very strong yen exchange rate, and it was trying to, if you like, go into some sort of purgatory after the asset bubble in the 1980s. So Japan basically let its debt to liquidity ratio soar. That created huge economic problems. And what they've been doing for the last 10 years, under initially Abenomics, but continuing that theme, they've tried to devalue the debt by printing money and letting the yen be trashed. And that black line has basically started to go down, and arguably it's got to go down lower to lower levels. Okay. If you look at the orange line, that is the equivalent Chinese debt to liquidity ratio. It's about 10 to 15 years behind what we saw in Japan. So what you've got to expect is the same thing going on, that the Chinese are trying to equally print money and they're trying to devalue the yuan exchange rate. Now, if you look at the next slide, what it shows there is PBOC, that's the People's Bank of China's liquidity injections. And this is a 6-month change, but just look at what happened at the beginning of 2025. There was a huge increase in Chinese liquidity injections. Now, evidence what's happened to the Shanghai stock market, it's soared. Evidence what's happened to the Chinese bond markets, yields have started to rise significantly. And what you're seeing is this blow off. Equally, what you're seeing is the Chinese yuan has begun to devalue very sharply. And if you look at the next slide, what you can see, hopefully, is the Chinese exchange rate. Now, what I have not done here is to look at the yuan against the US dollar. What I've looked at is the yuan against gold, because this is what the Chinese are focused on. They think they need to devalue their paper unit, the yuan, against real assets. Gold is a real asset. So what's going on here is that, in my view, China is ultimately driving the gold price. It's not just the Americans. It's not just the West. It's not just bad fiscal economics across advanced economies. It's also what's happening in China. And China's a big economy with a huge footprint, and it matters hugely, not least because they are the big buyers of physical gold, and the Shanghai exchange really dominates in that regard. And I would say, if you want to know who's setting the gold price, it's China. And China is monetizing. Now, why is it doing it right now? I think we can make conjectures. But my view is that what China is basically realizing is that stable coin in the US are a whopping great threat to the integrity of the Chinese financial system, and hence the Chinese Communist Party. And what they need to do is to somehow stabilize the system. Why are stable coins so important as a threat? Simply because if you're a Chinese exporter, where are you going to hold your wealth? Okay. Are you going to hold it in a Western banking system where it can be sequestrated? No. Are you going to hold it domestically in a Chinese central government digital currency where they can take it away if you don't behave? No. Why not put it in stablecoin? It's the obvious thing to do. So I think what the Chinese are trying to do here is two things. One is to devalue debt in their financial economy. In other words, to reconstitute and to, if you like, strengthen, make more robust the Chinese financial system. And secondly, what they're trying to do is to put gold behind that financial system. And in some form, doesn't necessarily mean going to a full gold standard, but it may mean that gold forms some part of the yuan. So this is the dynamic that I think is really important to understand over the medium term. You want these monetary inflation hedges because governments are cheating wholesale.
Lots of brilliant information in there. I just want to share something real quick before I forget it, Michael. And that's something that's happened also late last week. BHP Billiton shifts to our renminbi iron ore settlement with China, because the Chinese said, well, if we buy your iron ore, we're going to pay you at least 30% in renminbi. That's been big news here in the mining community and overall as well. What do you make of that, Michael?
Well, I think this is just another step down the road that I was describing. I mean, this is trying to get the Chinese yuan as a trading currency. And that's going to occur more and more, the more that it is backed by, gold or other precious metals. You've got that, underlying value there in the currency. It's not purely a paper unit. Now, the next slide, I think, is one just to maybe to pause on, which is saying this is an index of Chinese liquidity injections, which is the orange line. The two black lines, one is including energy and the other excludes energy, but it shows industrial commodity prices. And that's saying if China is going through with this full-scale monetization, and that's what the dotted line is trying to project, then you're looking at stronger commodity markets generally. And that is where you've got to start looking. I think the world is shifting from a financial asset boom towards a real asset boom. And I think China is part of that. And I think stablecoin and what I've labeled as Treasury QE in the US is also part of that whole equation.
My head is spinning, Michael. A lot really, really good content in there because I got a couple of follow-up questions, of course. Can you be a bit more granular on what that means? Like a gold-backed yuan, or what could that look like? We've been trying to make sense of this for the last couple of years. Do you have any inkling of what that could be like, or what it could be?
I think it's hard to conjecture exactly what they're thinking of, but I think that the more that I think you can maybe go down two roads. So you can think about it in two terms. One is to say that if China is accumulating gold against the yuan, either formally or informally as some sort of backing, it's going to make the yuan a much more attractive currency to hold and maybe to settle in. So I think that's one thought. The full scale thought is to say, well, okay, why don't they go onto a full gold standard? I think that's impractical. And I'm not saying that's going to be bullish for the gold price going forward, because clearly if they're fixing the gold price and they're targeting it, that is a rather different thing. But I think the process of traveling from A to B, if A is where we are now and B is a full-scale gold standard, they simply couldn't do it at the current exchange rate. They'd have to let the paper yuan devalue dramatically first. And if the paper yuan devalued, then all paper units worldwide, I think, would tend to follow that. So you'd be looking at a massive monetary inflation going on before we hit a full gold standard. Now, I'm skeptical about whether we'd actually do a full gold standard, but I think what we could do is do some sort of halfway house or some fudge in the middle. But I still think the fact is that China is building up this gold pool as backing. And if you're a commodity supplier to China, and you're supplying iron ore or you're supplying oil, for example, and you're getting yuan, which are semi-backed by gold, that may give you some comfort, particularly if you've got the ability to exchange that into gold through some settlement mechanism, which I believe the Chinese are already thinking of creating.
Hypothetically speaking, Michael, if China were to back the yuan with gold, wouldn't that automatically make it the next world reserve currency? Because who in their mind would own dollars if there's something gold backed available? Based on all the discussions we've had on this channel with all the guests before, believing that fiat is dying and the dollar is just a worthless piece of paper, wouldn't that automatically create a new world reserve currency?
Well, I suppose de facto, you're right, it would. I mean, the question, or the thing that would argue against that is if America coerces allies or other countries into holding dollar assets, or somehow it tweaks the system whereby it encourages a wider pickup of dollars. And I think stablecoin, as I indicated, may be that vent. And it's as I go back to the example, if you're a Chinese exporter, if you can't hold gold or you can't move gold out of the country, which is clearly the case, maybe stablecoin is one way to do that. So that may be, perhaps this is a race to get one or other currency system embedded. And it may well be that the West ends up with a financial system which is backed not by treasuries directly as it was, but it's backed by treasuries indirectly via the conduit of stablecoin, whereas the Chinese side of the world is actually a monetary system that's backed by gold.
Michael, coming back to the debt versus liquidity slide or discussion here, because I'm quite curious, what does that look like for the U.S.? And I can add your slide back here on the screen. I'm just curious, like, what does that look like for the U.S. in comparison?
If we go right back in the presentation, there's a version there for all advanced economies, and the U.S. is the dominant player there. So you can pretty much read that.
It does go much
the other way.
than
Go back.
Oh, the other way. Gotcha. There we go.
No, bit further back. I'll tell you when. Bit further back. Here. No, next one. That's it. So that's the debt liquidity ratio for all advanced economies. But you could read that more or less for the US because that's obviously the largest economy. The only other big one would be Japan in there, and we saw what Japan looked like. So this is dominated by the US. Now, if you look at that chart, the point about the chart is to say what's really key in terms of financial stability is maintaining a stable debt to liquidity ratio, which is what we are looking at here. The dotted line is a long run average. The data goes back to 1980. And what it says is that very broadly, you need something like 2 to 1 in terms of the ratio of debt to liquidity. In other words, that's what you need to roll over the debt. And that assumes that you've got something like a 5-year average rollover or average maturity of debt. So the point here being is who is going to do the roll? You need this liquidity base to do the roll. Now, if you don't get the roll, in other words, if there's not enough liquidity in the system, you've got a financial crisis. And if you look at the annotations that I put on the chart, what that basically shows is when you get crises historically, that's when the ratio is high. If you go to the other extreme, when you get very low ratios, you get asset bubbles because liquidity is not needed for debt refinancing. It's there in the financial system, and it basically goes into financial assets. And what we just had is the everything bubble. Now, what you're seeing is that orange line is starting to go northwards again, and that's obviously a worry going forward. Why is that? Because a lot of debt in the COVID crisis was termed out because interest rates were zero. It was termed out to the back end of this decade, and that's now coming up to be repaid. And the other is that the liquidity growth is beginning to roll over. Now, those are the two stories that are relevant in the near term. And if you look at the next slide, that basically shows that particular process. So this is the annual debt roll, and the red areas are the projections of the annual increase in the debt roll over the next 4 years. So you're looking at, sizable amounts of new debt, the old debt that needs to be refinanced in that period. Now, if you don't get the roll, what you start to get are financial tensions. And if you look at the next slide, what this is basically saying is that those financial tensions will be expressed in a widening in spreads in the repo markets. Excuse me. And what you see here is the SOFR less Fed funds spread. And when you start to see big spikes, what you're looking at is tensions, and those tensions can be expressed in a financial crisis. But you can see that's the problem. Now, why is that going on? Well, if you look at the next couple of slides, I think it's the next one on. What that's showing is the reason you've got this is that Fed liquidity is starting to slow down. And this is slated in the data. And it's basically because of a lot of technical stuff. But the Fed is continuing stated QT policy. And hidden QE, things like the Treasury General Account, the reverse repo program, have now fizzled out as sources of liquidity. And so what you've got is the potential for maybe up to a $300 billion drop in the size of the Fed, in the active part of the Fed balance sheet, the liquidity injections, which is about a 10% fall. And if you look at what happened last time that occurred, it wasn't good news. And you can already see, I think, in the following slide, that trade fails have begun to pick up. Now, this is looking at the net result of that Fed liquidity squeeze, which is falling bank reserves in the US. And those falling bank reserves are starting to see an increase in trade fails, which is the black line inverted on the right side. And what is that really telling us? It's saying that the primary dealers at the heart of the fixed income market, the treasury market, are basically seeing failures in their transactions. In other words, there's a failure to deliver, failure to either deliver securities or come up with cash required, and so you get a trade written off. And that's the size of trade fails. It's spiking because liquidity is starting to contract. Now, why is this going on? My view is because of what the administration is doing is it's swapping Federal Reserve QE for Treasury QE. Now, that's a subtle twist, but it means taking money away from Wall Street and giving it to Main Street. And in other words, the Fed's hose, which was sort of, being waved around everywhere and soaking every asset class, is now being focused on particular industries, be it technology, be it defense, in the US real economy by the federal government spending. And what they're doing is they're using stablecoin and effectively bill issuance to actually fund that program. So that's the shift. So what I would argue is that actually what we may be seeing in the next 6 to 12 months is evidence of a stronger, not a weaker US economy, or maybe a stronger, not a weaker world economy, in fact, because the Chinese are easing at the same time. And that would clearly be good for real assets. So this is the side of the fence you want to be positioned on. From a cyclical point of view, you want real assets. From a long-term standpoint, you want monetary inflation hedges, which are real assets.
2 plus 2, no, what is it? 1 plus 1 equals 3 in that equation, which is perfect.
Yeah, and both the Americans and the Chinese are helping us.
Fantastic. Michael, unfortunately, we're already at the end of our allotted time here, sadly, because I've got a ton of follow-up questions. Just in regard to, even the government shutdown. Maybe as a very last question, Michael, just with a short answer. Is the U.S. government shutdown having any impact on the liquidity?
Not particularly. I mean, not as far as we see. I mean, if anything, it's a negative because it's basically causing the Treasury General account to rebuild, but it's not noticeable yet.
Okay, so we're not worried about not issuing any short-term bills or any refunding issues or anything in the U.S. as of yet?
Not at the moment. If it continues, maybe.
Fantastic. Awesome. Michael, what a wonderful conversation. Always enjoyed chatting with you. You're definitely the godfather of liquidity, so really appreciate you coming on. Where can we send our audience to follow more of your work, Michael?
Well, I think the best way is to look at Capital Wars, which is on Substack. There we give regular 2-3 times a week commentary and provide a lot of liquidity data.
Fantastic. Awesome. Michael, thank you so much for coming on. It's always great to speak with you. We'll have to do this again very soon. Looking forward, maybe a year-end guidance. Maybe we'll do that at the end of December. We'll bring you back and we'll chat what 2026 might look like. So really looking forward to this. Everybody else, thank you so much for tuning in. What an insightful discussion here with Michael Howell of CrossBorder Capital. Make sure to go check out his Substack Capital Works, but also follow him over on X. Amazing insights on a daily basis. Also, he dissects the crypto crisis that we've seen last Friday as well. Lots of topics that need to be discussed from a very different point of view than we usually chat here on Soar Financially. If you enjoyed this conversation, hit that like and subscribe button. Helps us out tremendously. And of course, leave a comment. Helps us out as well. Thank you so much for tuning in. We'll be back with lots more. Take care out there.